Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about charitable giving, and specifically, how to do it in the most tax-efficient way. So if you're giving money to charity, how do you maximize the tax benefit of your gifts? And before we dive into it, we do want to mention that donating to charity isn't something you have to do, and we don't want anyone to feel bad if they aren't currently donating to charity. However, we know that for a certain segment of our audience, as well as the clients we work with, charitable giving is a relevant part of their financial lives. And while we talk about charitable giving and the tax benefits, we want to make it clear that you never want to let the tax tail wag the dog. In other words, you never want to donate to charity solely for the tax deduction. Instead, the idea here is that if you're already donating to charity anyway, why not maximize the benefit in terms of being able to reduce your taxes as much as possible? Lowering your taxes means the charity you give to ends up receiving the same amount of money, but at the same time, you're also left with more money in your own pocket, which you could either keep or even turn around and give back to charity. So by being smart with how you approach your charitable contributions, you can potentially even increase your charitable impact if that's what you'd like to do. And Andrew, I know we've talked about your fantasy football losses in the past, but just to confirm for everyone, those don't count as charitable contributions, correct?
Yeah, sore subject, and no, the IRS still hasn't come out with any guidance other than explicitly saying it doesn't count.
All right, just wanted to check there. So for today's episode, we're going to cover 5 specific strategies that you can use to give to charity in the most tax-efficient way. But before we get into that, we want to provide a little background and overview of charitable giving and some of the things to keep in mind. So Andrew, why don't you start out by talking about a few of the items there?
Sure. So at a basic level, the way charitable contributions work is that when you donate to a qualified charitable organization, as defined by the IRS, you receive credit for your donation in terms of being allowed to report it as a deduction when you file your taxes. Now, whether you're actually able to save on taxes as a result of your contribution is a different story. When you go to file your taxes each year, you add up all of your potential itemized tax deductions, which include things like charitable contributions, but also mortgage interest, state and local taxes, property taxes up to a certain limit. And once you add up all these deductions, if they're higher than the standard tax deduction that everyone is eligible for, which in 2021 is $12,550 if you're filing taxes single, or $25,100 if you're filing taxes married filing jointly. You take your itemized deductions, and if not, you can then take the standard deduction. So in effect, for most people, you'll only save on taxes related to your charitable contributions if you itemize your deductions for tax purposes. Now, prior to the Tax Cuts and Jobs Act of 2017, many more people itemized their deductions for tax purposes. However, as part of the Tax Cut and Jobs Act, the government doubled the size of the standard deduction, which led to far fewer people having enough in the way of itemized deductions to get over that level. For example, whereas prior to the Tax Cut and Jobs Act, more than 30% of individual taxpayers itemized, now that figure has fallen to less than 15%. So as you'll see with several of the charitable giving strategies we discussed, one component is doing things to get above the standard deduction hurdle to get that credit. So that's just a quick overview of the way it works with charitable contributions from a tax perspective to give you a sense of how to think about them and understanding of how things have changed in recent years. But now we'll jump into some of the more specific strategies that you can use.
Yeah, so the first one we want to discuss is donating appreciated shares of investments rather than donating cash. And this one is most relevant if you have a taxable investment account, which is also known as a brokerage account, a joint account, or an individual account. And it's an account that you can use to save and invest for different goals outside of your retirement accounts, things like your 403b, 401k, IRAs, etc. And you don't receive the same tax benefits for saving and investing to a taxable account as you do for some of the other accounts, but you also have more options and flexibility when it comes to tax planning, including charitable giving. So the idea here is that many charities are set up to receive in-kind donations of investments, whether those are shares of mutual funds, ETFs, or individual stocks or bonds. And rather than selling investments and then donating the cash, or simply donating cash you have available, you can donate the investments directly. So why would you want to do that? Well, we'll take a look at an example. So let's say you'd like to donate $10,000 to your favorite charity. At the same time, you have an investment in your taxable investment account that you paid $5,000 for, but is now worth $10,000. And you're deciding whether to donate it or donate cash. If you choose to donate cash, you'd have to sell the investment and then pay taxes on the difference between what you paid for it, $5,000, and what you sold it for, $10,000. So you'd have to pay taxes on the $5,000 of gains. If you held the investment for less than a year, you would pay taxes on this money at ordinary income rates, anywhere from 24 to 35% for most physicians. While if you held it for more than a year, you'd pay taxes at capital gains tax rates, either 15% or 20% for most physicians. So you'd receive credit for your $10,000 donation, but at the same time, you'd have to pay anywhere between $750 and $2,000 of taxes. Now let's assume that instead of selling the investment and donating the cash, you simply donated the investment. In this case, you transfer the $10,000 investment to the charity and receive credit for your $10,000 donation. However, since the charity is tax exempt, it will never have to pay taxes on the $5,000 investment gain associated with the investment. The charity can either sell it now or hold on to it, but either way, no taxes are due. So by going this route instead, the charity ends up with the same amount of money and you end up receiving credit for the same amount of charitable donations, but in the process, you're able to save up to $2,000 in taxes by not having to pay taxes on the gains associated with the investment. So as you can see, it's sort of a no-brainer to use this approach if you have a taxable investment account with appreciated investments in it. And if you're worried about donating an investment that you'd like and want to continue to own, this strategy is still better than donating cash, because if you still want to own the investment, you can donate the appreciated investment and then use cash on hand to buy the same investment in its place. But now you'll have no embedded gains with it, so you'll be back to square one from a tax perspective. So while not everyone has a taxable investment account, if you do and you're charitably inclined, you want to keep in mind the strategy of donating appreciated investments rather than cash as a tax-efficient way to give.
So the next strategy we want to cover is bunching your charitable contributions. Now, back to what I mentioned earlier with filing your taxes and receiving credit for charitable contributions. Now that the standard deduction has been raised for filing your taxes, fewer people are itemizing their deductions. And if you aren't itemizing your deductions, you won't receive tax credit for your contributions until you do. So for people who are married and filing their taxes jointly, they won't start receiving a tax deduction for charitable giving until their total itemized deductions exceed $25,100. And for individuals who file their taxes single, this number is $12,550. With that in mind, bunching your charitable contributions is one thing you can do to help get over that threshold where your contributions start to count for tax purposes. What bunching involves is, rather than donating the same amount each year, you combine multiple years of donations into a single year. And then you space out your contributions from there to, say, every other year or every third year. For example, rather than donating $10,000 to your favorite charity every single year, you could donate $20,000 every other year or $30,000 every third year. What this would allow you to do is, during the years when you donate, you'll have a much larger amount to report as part of your itemized deductions, which increases the likelihood that you'll exceed the standard deduction threshold when filing your taxes. So during the years where you make your bunch contributions, you itemize your taxes, while during the off years, you take the standard deduction, which you would have ended up taking each year anyway if you didn't follow the bunching strategy. The end result is that the charity ends up receiving the same amount of money from you over multiple years, but you're able to save on taxes along the way. Now, this is looking at it purely from the perspective of being able to maximize your tax deductions, but we know there are other considerations to keep in mind too. For one, we know some people like making consistent annual or monthly donations rather than periodic ones. And while following this strategy means the same amount of money ultimately goes to the charity, for some people it might feel better psychologically to make consistent donations each year rather than lumpier or chunkier, less frequent ones. We also know that not everyone has the available money on hand to make multiple years worth of donations in one single year. For many people, charitable giving is a part of their annual budget, and it's tough to fit multiple years of contributions all into a single year. So it might work better to that same amount consistently each year. If any of these things apply to you, that's totally fine, and don't feel like you have to follow the bunching strategy for your donations. There's no right or wrong answer as to whether or not to give to charity, not to mention how you do it. So while we're pointing out ways to do it in the most tax-efficient way, know that each person's situation is unique, and what works for them is ultimately the most important thing.
But to that point about how some people prefer to make consistent annual donations rather than larger ones less frequently, the next strategy we're going to talk about is a way to address that, and it involves using something called a donor-advised fund. And in basic terms, a donor-advised fund is an investment account that you can use to distribute money to charity. The way it works is that you contribute money or investments to the donor-advised fund and receive a tax deduction for the full amount when you contribute it. Then, once the money's in the account, you can manage it, including investing it to let it grow, and you have the flexibility to decide how much to distribute to charities each year. So in that sense, it's the best of both worlds for people who like to make consistent donations, since you're able to use the bunching strategy when contributing money to a donor-advised fund, but you can then make steady annual donations since you're free to decide how much to send from the donor-advised fund to charity each year. And when it comes to making contributions to a donor-advised fund, you have the option of transferring either cash or investments. So if you have a taxable investment account with appreciated investments in it, it's best to use that first strategy we discussed of donating those appreciated investments, since that'll be most tax efficient. Once the appreciated investments are in the donor-advised fund, they can then be sold and you don't have to pay any taxes on the gains at that point, since you give up your personal interest in the money by irrevocably giving it to the donor-advised fund and effectively earmarking it for charity. Another nice thing about a donor-advised fund is that you don't have to designate the recipient of the money when you donate it. So once the money is in the account, you have flexibility year to year to decide which charities receive money and how much. Additionally, you also have the freedom to donate at any time. The money invested in the account grows tax-free, and there's no time limit for distributing it out to charity. So overall, as you can see, a donor-advised fund is a really great option for people with the right set of circumstances for all these reasons we just touched on.
Yeah, now, the next strategy we're going to discuss is one that doesn't come into play until later in life. But for those people who want to continue donating to charity throughout retirement, or even increase their charitable activity in retirement, this is a great way to do that. And the strategy is making qualified charitable distributions from your IRA account. And to start out with some background, an IRA is an individual retirement account. So it's an account you use to save and invest for retirement. The way it typically works is that when you leave a job, most people transfer their employer retirement accounts, your 403b, your 401k, or 401a, to an IRA, which is called rolling over the account. So if you switch jobs throughout your career, you may already have an IRA account from your working years, from rolling over an old 403b or 401k, but at the very least, you'll likely have a large amount of money in the IRA when you retire. And in retirement, you withdraw money from your IRA and other investment accounts to fund your lifestyle. In terms of the tax treatment for a traditional IRA, you received a tax deduction when you initially contributed the money to the account, most likely through direct payroll contributions to your 403b or 401k during your working years. So when you eventually withdraw the money in retirement, you have to pay taxes on each dollar you take out at ordinary income rates. So going back to the idea of qualified charitable distributions, in practice, what these consist of are direct donations from your IRA to charity. While you don't get a tax deduction for your charitable contribution, since the money is going directly to charity rather than going to you first, you don't have to pay any taxes on the money being distributed out of your IRA. So this is often one of the most tax-efficient ways to donate to charity, especially for the typical physician with a large traditional IRA account balance. In terms of contribution limits, you're allowed to make up to $100,000 of qualified charitable distributions annually, which is obviously much more than most people give to charity in any given year, but know that this is a large amount of tax-efficient giving space that you can top up if desired. It's worth noting that you aren't allowed to start making qualified charitable distributions until you actually reach age 70 and a half. And another great thing about making these QCDs has to do with the required distributions you're eventually required to make from your IRA account. As I just mentioned, the money in a traditional IRA account has never been taxed, but the IRS eventually wants to get paid, which doesn't happen until the money is withdrawn. So the IRS has something called a required minimum distributions, or RMDs, where it requires you to start withdrawing money from your IRA account at age 72, regardless of whether or not you want to. The exact amount you have to withdraw each year is based on a divisor linked to your age, but the point is, once you reach age 72, you have to start taking money out of your IRA. However, most people have retirement accounts outside of their IRAs, such as taxable investment accounts and Roth IRAs, as well as retirement income sources from things like Social Security, so you may not need all of the money you have to withdraw from your IRA in order to fund your living expenses. If that's the case and you're charitably inclined, rather than paying taxes on the extra money and then either letting it sit in the bank or investing it in your taxable account, you could simply donate it to charity using a qualified charitable distribution and save on taxes. So that's an overview of the strategy and the thinking behind why you might want to use it, but we also want to mention a couple additional things here. One is that if you do make a qualified charitable distribution, be sure to let your CPA or tax professional know about it. These distributions aren't specifically reported anywhere, so unless the person preparing your taxes knows the money you withdrew from your IRA went to charity, they'll assume you used it for yourself and will therefore owe taxes on the full amount of the distribution. Second, qualified charitable distributions are only relevant for pre-tax IRA accounts rather than Roth IRA accounts. The biggest reason why is that you don't have to pay taxes on the money you withdraw from a Roth IRA, so there's no tax advantage to donating money directly from a Roth IRA to charity. You'd be better off using one of the other strategies we discussed, such as donating appreciated investments. Also, unlike pre-tax IRAs, Roth IRAs don't have required minimum distributions, so you aren't required to start taking money out of your Roth IRA once you reach a certain age.
Now, the last strategy we're going to discuss is definitely the most involved and complicated of the five, which is going out and starting your own nonprofit. And the biggest reason you would want to go this route is if you wanted to broaden your charitable impact beyond just yourself. When set up properly and after obtaining official nonprofit status, known as 501c3 status, this allows you to not only make contributions to the organization yourself and receive the associated tax deduction, but it also allows you to collect donations from other people who also receive a tax deduction for their gifts. And bigger picture, since you set up the nonprofit yourself, you'll have the ability to decide how the funds are used and direct them to the specific causes that you care most about. For example, we have several clients who are passionate about various causes and not only wanted to take a more active role beyond simply donating money to existing charities, but also wanted to share their passion with others by enlisting their financial support as well. So they decided to go ahead and start their own nonprofit. Now, we should mention, as I alluded to, that starting a nonprofit isn't a simple undertaking. It involves hours spent with a lawyer drafting the documents and applications, time spent deciding on the structure of the nonprofit and its operation, hiring a CPA or tax professional to prepare the tax return, etc. And that's just on the front end to get things up and running. On an ongoing basis, it then involves the actual work of operating it, going out to raise money, and keeping in compliance with the requirements to maintain your nonprofit status, including certain requirements about the composition of your donor base. So even more so than any of the other strategies we mentioned, this is obviously something you wouldn't want to do solely for the tax benefits. But for people who are passionate about causes that may or may not already have charities devoted to them, or for people who want to have a bigger, more direct impact on the causes they already support, setting up your own nonprofit can be a really exciting and fulfilling option. And we can say from our own personal experience working with clients who've decided to go this route that it's been so much fun to see and to share in their excitement and enthusiasm as they make a real difference firsthand. Well, that covers everything we wanted to discuss when it comes to donating to charity in a tax-efficient way. Hopefully this discussion gave you a good understanding of some of the different options and strategies out there, as well as some of the insight into whether they might be appropriate for you. And with all these strategies, we like to highlight what's possible and the thinking behind them, but we always recommend consulting with your CPA or your tax professional before implementing them, just to confirm that they're right for your personal situation. And we work closely with our clients' CPAs when it comes to tax planning, and we recommend the same approach for anyone listening. And just to give a quick recap of the strategies we covered, number 1 is donating appreciated investments. So rather than donating cash, if you have a taxable investment account with appreciated investments, you can avoid paying taxes on the gains by simply donating those investments directly to charity. Number 2 is bunching your charitable contributions. If you take the standard deduction when filing taxes, but make material contributions to charity each year, consider bunching multiple years' worth of donations into a single year, if that means being able to get above the standard deduction and receive tax credit for your donations. Number 3 is a donor-advised fund. So if you like the strategy of bunching your contributions for tax purposes, but also want to be able to continue to make steady annual donations to your favorite charities, consider using a donor-advised fund to achieve both. Number 4 is qualified charitable distributions. If you're age 70 and a half or older, are charitably inclined, and won't need the full amount of required distributions from your IRA account to fund your lifestyle, consider donating to charity directly from your IRA using a qualified charitable distribution. And lastly, number 5 is starting a nonprofit. So if you have specific causes you're passionate about and also want to be able to broaden your impact beyond just your own donations, consider starting a nonprofit to amplify your impact. Well, thanks everyone for joining us for another episode of the show. If you want to check out the show notes, you can find them at mdwmllc.com/podcast. And as always, you're also welcome to email us at info@mdwmllc.com if you have any thoughts or questions to share. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.